I have seen student loans be the one thing that stands in the way of many Americans buying a home. And if you've been in this situation, you know what I mean. You are sitting there across from a lender, you supply all of your documents. The lender reviews, income, good. Credit score, good. DTI, not good. He tells you your student loans are too high, and you don't qualify. You're absolutely heartbroken. Lucky for you, just 2 days ago, FHA has made a huge change that I know you guys are going to be excited about. Besides looking at just your credit score and your income, lenders have to use your debt to income when pre-qualifying you for a loan. A big factor that goes into your debt to income is student loans if you have them. So in the past, lenders used 1% of your outstanding loan balance on your student loans when figuring your debt to income ratio. Now, this was a problem for many home buyers because in most cases, using that 1% of the total loan balance was much, much higher than the payment that they were responsible for on a monthly basis. But the good thing is this has all changed now. New guidelines were just released 2 days ago and are effective immediately that allow lenders to use a smaller portion of your student loans when calculating your DTI. Now, if you are on an income-based repayment plan, lenders are allowed to use the payment that you're actually responsible for. I know, groundbreaking. The cool thing here is that no matter what that payment is, if it's $5, if it's $100, they're using that instead of the 1% of your outstanding balance. Now you may be thinking, Nicole, that sounds great, but what if my loans are in deferment or my income-based repayment plan shows that I'm responsible for $0? Well, in that case, there's still good news. The new guidelines state that lenders should only use 0.5% of your total overall balance when adding that into your debt to income ratio. So this is essentially cutting that total amount that they were using just 3 days ago in half. This is such big news that you need to hit the share button right now and send this to all of your friends and family members. You do not want to let them miss out. Now let's take a quick dive into these numbers so that you can see how this directly impacts your purchasing power. In this example, we're going to start off with the old way that lenders would do this calculation. So some constants that we're going to hold while looking at the old way compared to the new way is that you make $40,000 a year, you have a $400 a month car payment, and you pay $300 towards your credit cards every month. So go ahead and plug in your own numbers here if you want to do your calculation along with mine. In the past, lenders would have to use 1% of your total student loan balance in your debt to income ratio. Knowing that in order to get pre-approved for an FHA loan, your debts cannot exceed 57% of your $40,000 a year income, so the maximum debts allowed is $22,800. So if we add up all of those debts that we talked about, plus the 1% of that $50,000 student loan, which would be $500 a month or $6,000 a year, that brings your current debts to $14,400. So if we take your maximum allowed debt, the $22,800, and we subtract what you currently have as debts, which is the $14,400, that leaves you with $8,400 left in a year to go towards house payments. So if we divide that number by 12, that would be a monthly house payment of $700 a month. Now, I don't know what the prices are like in your market or how much $700 a month can get you, but I know where I'm at, it's not very much. Luckily, we're not using that model anymore. The new way lenders are calculating this. So we'll start with the 0.5%. So this would be applicable to you if you are currently not paying on your student loans or your income-based repayment is $0. So the only thing that changes in this example as a debt is how that student loan is factored in. We are going to use 0.5%, which would be $250 a month or $3,000 total. So that would bring our total debts currently to $11,400. If we subtract that from the maximum debt allowed, which is the $22,800, that gives us $11,400. If we divide that up by 12, that is going to give us a monthly payment of $950 a month. So you can see we're moving in a positive direction. This 0.5% versus a full percent gives you 250 more extra dollars to work with, and nothing on your debt or your income has changed. Let's move over to the best possible solution if you are on an income-based repayment plan already. So if we add up all those debts that we've used in the previous examples, plus let's say that you are on an income-based repayment plan with only $50 a month, which comes out to $600 a year. That puts your current debts at $9,000 for the year. So if we take that $22,800 and we subtract $9,000, that leaves you with $13,800 for the year to go towards a house. Now, of course, we divide that by 12, we are up to $1,150 for a house. That is much more doable as a house payment than just $700. So you can see how great this is because your income did not go up. Your debts didn't necessarily go down. But just because of these changes that are effective right now, you can magically afford a home payment that is worth hundreds of dollars more. That can turn into tens of thousands of dollars on an increase in your overall purchase price. This is great news for home buyers that maybe weren't able to get pre-approved for a loan before because of high student loan balances that were eating up all their debt to income. I keep thinking back to how much this would have changed my life as a first-time home buyer because I used an FHA loan to buy my first house, and I used student loans to get through college. And when I filled out that loan application, I was thinking like, yes, I'm gonna have enough money to buy a great little starter home. Can't wait to entertain all my friends. Guys, I was pre-approved for $124,000. Like, this was not the budget that I had hoped. And to be honest, that left me with 3 houses to choose from. I was very, very limited. And that was all due to the fact that at that time, they were using 1% of my total loan balance for my student loans, and I literally had not even started paying on them yet. But of course, it's not all rainbows and roses. This could be bad news as well. On a national level, we are going to be seeing more buyers enter the market, and these are buyers that most likely have been turned down from getting loans before. So they are going to be hungry and they are going to be ready to compete. So if you are already in the market, just be aware of that. So here's what I want you to do. If you are currently pre-approved for an FHA loan and you have student loans, call up your lender this week and ask them how this new guideline change affects you and your pre-approval. If you are interested in buying a house but have not been pre-approved yet, check out this video I made specifically walking through the first-time homebuyer mistakes and things you need to know before jumping into this. I will see you in the next video.